Thank you all very much for stopping by to watch our Life Goal Investment Vehicle video. Today we're going to discuss 4 different investment vehicles: the ETF or exchange traded fund, the mutual fund, stock, and bond. We'll discuss the characteristics of each of them and how they differentiate from each other. And then interestingly, we're going to compare each of them to a vehicle from Ford's lineup in order to hopefully make it more real life and tangible for you. So let's take it back to the original investment vehicle, which is a bond. What is a bond? A bond is essentially one person or institution agreeing to lend another person or institution money for a fixed period of time. So let's use a US Treasury as an example, and I'm the investor. If I buy a 10-year US Treasury for $1,000, the US government is promising to pay me back $1,000 at the end of that 10-year period. But they'll also pay me whatever the yield is. So if it's a 2% yield, they will pay me 2% every single year along the way that I hold on to my money. So I gave them $1,000, I get 2% every single year, and they give me that $1,000 back at the end of the 10 years. That's what a bond is. So generally, are bonds diversified? No. In that example, I only lent money to the US government. Generally, are they free to trade? Now, unfortunately, there's generally a commission associated with buying or selling bonds. Is there no lockup? Yes, there is no lockup. Generally, I can buy a bond and sell it back into the market whenever I want. Is there no minimum? No, unfortunately, there generally is a minimum associated with buying bonds. Is there a management fee? There is not. And then lastly, is it tax efficient? Tough one, maybe. Some bonds are tax efficient, some bonds are less tax efficient. The fun part, what Ford vehicle is similar to the bond investment vehicle? Go back to the original Ford vehicle, the Ford Model T in the 1920s. It was known for its reliable and consistent nature. And what are high quality bonds known for? Their reliability and their consistency. What's the downside? The Model T is just not that fast. Nor are bonds. They don't have the ability to make as much money in a short period of time as some other investment vehicles do. But they also come with that reliability and consistency on the other hand. So that's why a Ford Model T is a bond in our comparison here. On to the next one. Stocks. What are stocks? Stocks are essentially a percentage ownership in a company. I can buy Ford shares, and essentially I have a percentage ownership in Ford. As the value of Ford as a corporation goes up, the value of my stock shares go up along with it. Conversely, if the value of Ford goes down, the value of my stock shares also goes down. So, generally, are stocks diversified? Now, in my example there, I only own Ford. Generally, are they free to trade? Yes, they are. Is there no lockup? Yes, stocks can be bought and sold back into the market generally on the same day. Is there no minimum? Yes, so long as you can afford one share of that stock, you can buy it. Is there a management fee? There is not. And then lastly, is it tax efficient? Yes, stocks are generally pretty tax efficient. So the fun part, what Ford vehicle is similar to owning individual stocks? And that's the 1970s original muscle car, the Ford Mustang. Now, what's the great thing about a Ford Mustang? It's loud, it's sexy, and it's potentially very fast. And so with that, stocks are as well. They have the ability to make a significant amount of money over time, and sometimes even in short periods of time. Now, what's the downside? Would you buy that 1970s Ford Mustang for a new driver in your household? No, probably not. And why is that? Because it doesn't even have an airbag. I'm not even sure it has seat belts. So, like that, individual stocks also have a significant amount of risk associated with them. The downside is also very considerable. So they have the ability to go up quickly, but they also have the ability to go down quickly. And that's why stocks are a 1970s Mustang. All right, on to the next part. And you'll see in the middle of this board, there's a thick black line. On the left-hand side, we're talking about individual stocks, individual bonds. On the right-hand side, we're talking about mutual funds and ETFs, exchange-traded funds. Very different over here. These are what we refer to as pooled vehicles. Essentially, all that means is a portfolio manager is able to get money from a bunch of different investors to then be able to afford to go out and buy lots of stocks and lots of bonds potentially. So that's what we're talking about with mutual funds and exchange traded funds. So generally, are mutual funds diversified? Yes, they are. Just mentioned that. Generally, are they free to trade? Maybe. It depends on the share class that's being bought or sold. Is there no lockup? Maybe. Also depends on the share class. Is there no minimum? No. Unfortunately, there is a minimum associated with buying mutual funds. Is there a management fee? Yes, there is. You have to pay someone to buy and sell those underlying stocks and bonds. And lastly, the important question, is it tax efficient? No. Unfortunately, it's not tax efficient. What do I mean by this? Not to get too detailed, but for example, if the portfolio manager owned Ford stock inside the mutual fund, and he bought it when it was a low share price and wants to sell it when it's a much higher share price, we as the shareholders may be responsible for paying what they call capital gains tax. And therefore, no, a mutual fund is not a very tax efficient vehicle most of the time. All right, what Ford vehicle is similar to a mutual fund? A Ford Escape. What is a Ford Escape? Well, it just won the 2020 SUV Safety Award for the year. So what is that saying? That's saying it's diversified. It has lots of different stocks, lots of different bonds. It's not just incumbent upon the success of one company. It has very diversified lineup. Now, what's the downside of a Ford Escape? Well, it's a gasoline and internal combustion engine, and with that, you have to pay to get your oil changed. And that takes us back to this tax efficiency that I talked about before, lack of tax efficiency. You may be responsible for paying capital gains tax or oil changes throughout the year. All right, on to the last one. The ETF, the exchange traded vehicle. Generally, is it diversified? Yes, it is. Generally, is it free to trade? Yes. No lockup. Yes, there's no lockup. You can buy and sell it generally within the same day. No minimum. Yes, there's generally no minimum associated with an ETF. Is there a management fee? There is. Just like the mutual fund, you have to pay someone to determine what to buy and sell within the portfolio. And then lastly, tax efficiency. This is where an ETF really differentiates itself from a mutual fund. It is tax efficient. So to use that example of Ford and the portfolio manager buying it within an exchange traded fund, if they bought it at a low price and sold it at a high price inside of an exchange traded fund, we as the shareholders are generally not responsible for paying capital gains tax. Very different from that of the mutual fund that we just discussed. So the fun part, what Ford vehicle is similar to an exchange traded fund? That is the new electric Mustang. So like an Escape, it has airbags and seat belts because it's diversified, right? But the other differentiator there is that unlike that Ford Escape and the internal combustion engine, the Ford electric Mustang doesn't have to get oil changes. So it doesn't have to pay that capital gains tax that you may experience inside that mutual fund. So very different. Anyway, we hope you enjoyed our analogy here of investment vehicles and Ford's vehicles. Thank you very much for stopping by and have a great day.